Hey guys, welcome back to We Talk Money. Today I've got a special interview, one that I've been looking forward to for years actually. I've got my good buddy Billy Murphy. Hey man, thanks for being here.
Thanks for having me.
Yeah, dude. So we've had so many good conversations off camera, and every time I'm like, dude, we should be recording this right now because so many people would get a ton of value out of this. And you just think uniquely, right? Like I hang around traders and investors all the time, but I feel like you're actually on like a different level, man. The way that you think about risk and bets and like sizing and money, it's just, you have such a unique perspective, and I wanted to get that on camera.
Thanks, man.
Yeah.
I appreciate it.
So your background, I guess you got started as an entrepreneur and then in poker, and then you moved into making some very large concentrated bets, which if a lot of people heard about them, they'd say, wow, that was super risky, or my God, that takes some big cojones to like do something like that. But they paid off and you've done really well. And you're also, I guess I could say you're writing a book on this subject. So this is like perfect timing before the book comes out. Like, yeah, let's just start with your background, like with poker and building businesses and how that's translated into what you're doing today.
Yeah, so I learned poker in college.
Yeah.
So I don't know how much you want me to get in the background of poker, but it was just, I didn't initially know you could make money at it.
Yeah.
And then I learned people were making money at it. So I was making like, just learning the game. And I started making like $1 a day, and I couldn't believe you could really make money at it. And then I really started diving in and realizing like, oh, you can make real money at it. So I learned poker, left college, got a job for a couple months, and I was like, this is not the path. Started playing poker full time, did it for maybe 3 or 4 years, and then started launching businesses from there. And
Were you doing online poker or in-person poker?
Yeah, almost some live poker, but almost 98% online poker.
Okay. And this is before what was it called? Black Friday or something? Yeah. What was that? The government basically ended the online poker scene in the US?
Yeah, they basically made it extremely difficult. I guess they technically didn't ban poker. What they did was ban the ability for banks to be people to get money in or out. So people had to basically be dealing with offshore type of companies, which meant either go to European companies or just deal with like the little kind of sketchy sites.
I think that was part of like the whole Operation Choke Point, where the government was going after like a whole bunch of industries at the same time. And I think poker got caught up in that. And now they're doing Choke Point 2.0 with crypto, going after the on-ramps to the banking system.
It's that was the first time. I mean, I've never really paid too much attention to politics. That was my first time. And it's like, oh, like certain people control what happens, and it is not always for the right reasons. So basically what happened, and I don't know every detail about this, but there was some sort of military bill that needed to be passed, and somebody in the 11th hour put something in that banned the ability to fund online poker rooms and things like that. And so it had nothing to do, like they wouldn't have approved it. There wasn't enough approval for it. So they snuck it in to the back end of a bill.
Yeah.
And then overnight, it was just people's livelihoods were like, people either had to retire, like change industries. And we're talking like 25-year-old, 30-year-olds with like, all of a sudden they're saying like, you can't do this. Or move out of the country. And some of these people had families and things like that. So it totally changed the landscape.
So what did you do when that happened?
I was already out of playing.
Okay.
I had a poker company though at the time, and immediately, like overnight, over the next 30 days, 60 days, whatever it was, we probably lost a third of our business.
Really?
Because all of our customers we were training people to play poker. And so but we trained more advanced players. And so most of our people were professional or semi-pro players. All of a sudden, a lot of those guys didn't have a job anymore.
Unless they just left the US.
Even
then, did that basically kill the industry, or?
It just shrunk the size of the player pool a lot. Like, because it wasn't even necessarily the pro poker players that shrunk the pool, but the most of the money professional players made was from American leisurely players, like people who just wanted to log in after work, have a good time.
That was the dumb money, right?
Bucks. Yep, that was who you made your money off of.
Yeah,
and so all those players left, which means the game's harder. Which then it became, pros beating the lesser level pros. So some of the people just couldn't make a living anymore because the games were tougher.
Yeah, it's like the competitive arena got harder.
Basically took out all the easy players, and it's like, can you beat the pros? And or people would play on the smaller sites that were like less secure and just play at different times when the European players were playing. But then again, so many people were playing it. It's just supply and demand. If everybody's doing that, now those games aren't easy either.
Yeah. The same thing kind of happened with day trading back in the day, like the late 90s, early 2000s, when electronic trading was new. It was like shooting fish in a barrel. And some of my mentors were making a full-time income doing that. And then by the time like the global financial crisis came around from like '08 to '12, it was like a lot of algorithms came in and competed away those short-term profits.
Yeah.
And so I was looking, I'm like, man, this is crazy. Like it's so much harder to day trade. The only way that I can really make money is holding longer periods of time because the volatility was going down. So less dumb money, the competition was going up.
Right.
Thankfully, I fell right into Bitcoin in 2013, and that was a whole other game.
Yeah.
But yeah, talk about like what was the progression with how you saw like just the mental game of poker and how you like applied that to other things.
Yeah, it was with poker, it was every single decision you make, there's an optimal decision and a suboptimal decision, right? You don't always know. For example, when I'm playing poker, I'm a little bit less concerned with what I have. I'm trying to figure out what you have. And when I say what you have, not your exact two cards, because that's impossible, but you're trying to find a range. So each move you make based on the moves of the other players, the money in the pot, all these things are individual variables.
Mm-hmm.
And so each time you do something, your range is narrowing in my head of what I think you have. And the more you play with someone, for example, if we play one hand together, I have no idea what you have because we have no background. But if I see you play 100 hands and 1,000 hands, all of a sudden I'm like, okay, I know what he does in these spots. I know what he does in these spots. So I'm able to narrow your range. So in poker, once you have that range, it's like, okay, how do I make the optimal decision to either make as much money as possible, make you put in as much money as possible if I have the superior hand, or get you off of a hand if I don't think you have a good enough hand to withstand like a big bluff, for example. And all of these decisions are like, if I make a big bluff, I'm not saying I know you're going to fold. I'm saying I'm betting that you will fold enough times so that it's profitable for me.
Yep.
That's all I care about. So if an amateur would watch someone like myself play poker, they might think I'm like this crazy player, like, oh, he's always bluffing or he's raising all the time and doing these things. But there's a method to like why I'm doing it that way. Like I'm only doing that if I can bluff you off your hand, for example. If I know I can't bluff you, I'm never bluffing. All of a sudden I'm playing the opposite strategy. It depends on the player. And so again, I would just look at the math. Like let's say there's $1,000 in the pot and I'm betting $1,000 and I think you're going to fold the hand. You may call, but I don't have to be right every time for that to be very profitable because I'm betting 1,000 to win 1,000. But if I can't win the hand with my hand, that's my only shot, right? I win the hand 0% of the time if I don't bluff. So you're looking at the math on like what percentage, if I think you're going to call 100% of the time, clearly I'm not going to do it. If I think you're going to fold 0% of the time, you're trying to find that number in between where it's like, it's still profitable here. So do I think he's going to fold more than X% of the time?
Yeah.
And so in poker, this is the way you think every hand. Where in business, I realized I don't understand why no one is thinking in these ways. In terms of opportunities you're pursuing, like, what is the math? And again, I think a lot of experienced and successful entrepreneurs probably do think this way. They may not know the same terms and all that kind of stuff, but a lot of beginners, since no one is really referencing how they think and the math behind their decisions and why they're doing certain things, I think I see a lot of like kind of beginner intermediate people that there's no thought process, that they're just guessing.
Yeah.
And it's it's fine to guess with some math behind it so you come to an optimal conclusion, because when you get more data, now you have new data to put in the equation and say, okay, based on new data, I can change my decision now. But they never get to a point where you're like, this is how much I expect to make. This is how much I'm going to bet. And, based on my feedback, now I'm going to bet more or less. They just, it feels like gambling.
Yeah. We see this in trading, like especially in the crypto markets and, penny stock traders and stuff. It's very rarely is a decision made on like logic or odds or bankroll management. It's usually gut feels, chasing a guru, emotion-based stuff. And I think that's why the majority of traders lose money to a small percentage of people that have been in the game a long time and know how to survive long-term.
Yeah.
It's interesting though, like how poker, you have like this human element. I guess especially if you're playing in person, you can look at your opponent and get data and maybe find and exploit an edge that you can't in the markets. So I wonder if like poker's actually, I don't want to say easier, but you have that extra element to it that's kind of nice. Like you can realize when people are making really stupid emotional bets or decisions.
Yeah, it definitely adds a variable. Yeah.
Can you see that online too, or is it harder to see when you're playing digitally?
Online, the couple of things you're looking for in that is, and the same thing with live, like it's more the betting patterns. For me, it was always looking at like, okay, he bets this size when he has a good hand, or he bets a little quicker, or those kind of things. Yeah. Where you can do that, you see that online too. Or if someone just loses a big pot, they may play a little differently, trying to get the money back, or playing poorly now.
Yeah.
A lot of people get their emotions involved. So you see those things, but again, the live aspect, it's a little bit over. I think people put too much weight on it. Usually, there are a couple little things. For example, if I go into a room and I see someone with a hoodie and a backpack, you immediately know. He knows it's going to be cold in there. Most of them, like they know it's going to be cold. Like I wear, like they pump air in there, so it's
to keep
cold
you awake.
In casinos.
Yeah.
So if someone goes in there and they're wearing like a tank top and they have a nice watch on or whatever, he was probably at the casino, rolled into the poker room, those kind of things. Like he's less likely to be the pro. Where the kid with the backpack, who's probably got, a lot of professionals carry a backpack because they keep a stash of money if they need more money, right? So like the little tiny things like that, where it's not correct 100% of the time, but you notice those kind of things.
Yeah, interesting. And so, okay, how have you taken the mental game and the thought process that made you successful in poker and applied that in other areas of your life?
Yeah, so when I was starting in business, I would always kind of calculate what I thought an opportunity could make. And I probably overthink about those things. Like I just love that subject. So I probably do it too much, where I want to calculate like, here's the value of this opportunity. And so what I would do, and I still do it when I start a business, is here's what I think this business potential is. And when I was starting, it was important to be like, okay, but what is the expected value of this decision? If I start this business, what do I expect to make? Mm-hmm. And so something like expected value is like it's not as complex as people think. You're just taking, for example, if I'm starting a business, if I say, here's the potential of the business, I think this can make $50,000 a month or whatever. Well, let's say I'm only going to be successful 50% of the time. I'm going to lose 50% of the time. The majority of people will not make that bet. And it doesn't make any sense. So they stop before they actually get to any math. So they say, I don't know if I'm going to succeed. Therefore, I will not go forward. I will take the safe route. But the safe route is actually significantly riskier because people are constantly choosing decisions that have a lower EV. Where in one decision, not that big of a deal. 10 decisions, not that big. But if you go, if we're making hundreds of decisions a year like this, and then extrapolate over 40 years, like that is the difference between someone worth 100 million and someone who's only worth 100 grand. And so, for example, on a business, if I say it can make 50 grand a month based on my due diligence, based on competitors, the market size, these kind of things, I think I might fail 50% of the time because, I'm not in the business yet. I don't know for sure. Therefore, my expected value might be 25,000 a month. And so then I would look at it and say, okay, well, if it's going to make 25,000 a month, maybe it'll make 300K a year, 300K a year. If you get even just a 3X multiple, maybe this is like a $900,000 business that I could sell. So I think about things in those terms where a lot of people don't get to that point. Then again, as you get, if I said, okay, based on this, let's pretend this is a business I wanted to pursue. Like this is something is big enough for me. Okay. So I start pursuing it. If I get data that says I'm incorrect, this is no problem. I can always say, you know what, now that I have new data, it tells me this opportunity is much smaller, therefore I know to get out.
Or kind
Or
of like putting a stop loss on it, right?
yeah, it's not a big deal where I think a lot of people look at it as like, oh, like I got to go dedicate the next 10 years. It's like, no, like put in 6 months and see if you have the correct data and go get more data. And the thing about business is, and it's probably the same with trading, the more you're in an opportunity, you will have now like insider info, not necessarily insider info, but it's like you'll have access to info that other people won't have dug for because you're in the industry. So a lot of times you'll find opportunities you didn't know existed, which turn the opportunity much bigger than you actually thought it was going to be.
Yeah. Yeah. The informational advantage.
Yeah.
So let's talk about some concentrated bets that you've made.
Yeah.
This is what I'm excited about because, one, you approach things with a really like profitable framework. You know how to like think about risk.
Yeah.
And then you've actually applied it and had some home runs. So you want to talk about some of those?
Yeah. So I made, and it's funny, man, like when I really haven't talked about these a lot, but when I tell a couple buddies or whatever about these, kind of when people say, hey, how do you invest your money? It sounds insanely risky, but they seem like the safest bets to me. Like they don't seem risky at all. When I think I was like 28-ish. So about 28, I hadn't made a lot of money yet, but I'd made, I was starting to make a decent amount of money. And so I think my initial bet was 500,000. So I put 500,000 into one stock. And the reason was, there's a couple of reasons. At the time, my thought process was, okay, well, here's a bet where I think, like the stock was Apple. And this is back like 2011-ish. So at the time, Apple was trading extremely low price to earnings ratio. It had a bunch of cash in the bank, and I think their R&D, like they were spending a lot in R&D. I can't remember the exact numbers, but they're spending a ton in R&D. And the way I think about R&D, like I'm not some expert stock trader or anything. Like this is like my one stock that I still own. I don't own any other stocks. The way I think about R&D is like those are plus EV bets. And when someone's making plus EV bets, those are going to pay off. And I think a lot of times this happens with employees, business owners, traders. People focus on profits too much, and they don't realize the plus EV bets you make today are the profits of the future.
Yep.
And they were placing these huge bets, and people were saying, oh, Apple's done, Apple's small. It's like, are you guys not seeing like that I think they might have been already the biggest in the world at R&D, or they were growing in that trajectory. And it was like, how is people not seeing this? And they're already extremely low PE. Didn't calculate for the fact that they had all this cash. So if you took out the remainder of the cash, their PE was another like several points lower. And so when I make a bet, I look at the margin of safety. I say, okay, if this doesn't go well, what's going to happen? I'm like, it's already really low. Could it go lower? Sure. But, and I think this is the other thing when people allocate capital, they think about it with the whole number. Like when I allocate 500,000, I don't look at it as like, I'm going to make this bet and it goes to zero if I lose. Like if you look at it realistically, if I make this 500K bet and it goes horribly, maybe I have 300. Like it's not the end of the world.
Yeah.
But if it goes well, it's going to compound at significant rates. And so I'm like a long-term kind of, Buffett, Munger disciple of like, I'm not looking to be active. And therefore I'm going to place bets that I think will do well in the long run. They'll compound tax-free, which, not paying taxes on it, compounding long-term adds up a lot. And so, I think this bet is up 12x or something like that, and it's you spend zero time on it. But a lot of people would say you're not diversified, because that was like almost all, I don't know the percentage, but it was like 95% of my cash at the time, somewhere from 90 to 100%.
Wow.
And so it's basically everything outside of like living expenses and things like that. A lot of people would say, that's wrong.
That's
You're not
foolish.
you're,
That's
you're not,
risky.
yeah, you're not
Yeah.
diversified. And whenever I challenge people on diversification, they don't actually understand what they're saying. So it's like, what is diversification? It's like, most people, that means sprinkling around a bunch of money on stuff they don't understand, that they haven't priced out, that they don't understand the value, that they just say, well, I'm trying not to lose, so I'm just going to bet on a bunch of stuff. I have no idea what it means. Or like, whether it be index funds, whether it be just a bunch of random stocks they're picking, placing money on a lot of things that are either bad or neutral bets is you would call it diversification, but that's horrible if that's what diversification is. The way I think about diversification is, I do want to be diversified to an extent, but over time. It doesn't make sense when I'm 28 years old. I'm not trying to just make sure my 500 doesn't go to 300.
Yeah.
Doesn't make any mathematical sense in any world. Like, any sort of guru that's saying that it doesn't understand all the variables at all. And I think that's the trap, is that a lot of people are saying these things, and then there's the next level, like regurgitators of the gurus, and like no one has actually thought through what they're saying. It's like, if you're taking 20-year-olds and telling them to diversify, it's like, that person's never going to be rich. And so the way I look at it is like, I want to make bets where I think are significantly plus EV relative to other opportunities, and then I want to make more of them. And so if you have a couple bets that you can make, let's say you've priced them out. Let's say, you think one is worth this, you think one is worth this, and you think one is worth this. A lot of people just sprinkle bets in all three of them. You want to put as much money as possible in number one. You don't go make bets on like the worst opportunity to call yourself diversified. And then X amount of years later, when you see another bet, you put your chips there. And so, for example, like, I haven't sold, like, that's just, I don't touch it. It just stays there, compounding tax free. And then other cash that I have, when I see a big bet, I place my chips, because I want to return large sums of money with little work.
Yeah, man, there is so much to unpack here. Oh man, this is so interesting. So, because it goes against conventional wisdom, right? Like you said, I mean, so many people preach diversification without really knowing why. I think I get the argument, but I tend to be in your camp of like the idea of finding really asymmetric bets, where you look at the downside and you say, Apple's not going anywhere. Could they lose money, and could my thesis fail? Yes.
Yeah.
Am I going to get wiped out of the game with a big bet? Probably not. What's the upside, right? Like 12x. It's so, oh man, I just love this so much, because I did something similar with Bitcoin back in 2013.
Yeah.
I didn't do 90 or 95% of my net worth, but I did a percentage that was really uncomfortable. At the time, it was like a third. But I did the same thing. I looked at the risk to reward. I guess this was actually 2015, because Bitcoin had gone from like 100 to 1,000 and then was back down in like the 1 to 200 range. And I was like, risk to reward, I'm like, it's down 90% plus. Yeah. It could go to zero. And if this goes to zero, it's going to hurt like hell. But if it 10 or 100x's from here, I can't ignore that upside potential. Right. So I had that kind of that same idea, but I'm like, how do I manage this in a way that leaves me with no regrets, no matter what the outcome is? If it goes to zero, okay, cool. I lost a third of my net worth. I can work and make that back. Yeah. If it goes 100x, I want to have enough skin in the game that it's going to be meaningful, right? And so that did happen. But yeah, how do you think about bankroll management and like, yeah, I guess just the the conflict there between being so concentrated
Yeah.
and like really, having so much skin in the game. And like, did you think about that when you went all in on Apple? Was it like, what is the worst case? What do I
Yeah.
do if this implodes? Like, and how do you think about that in general, I guess, with other big concentrated bets?
Yeah. So it's the way I think about it in terms of, because you mentioned bankroll, it's like, yeah, you don't want to make bets that could take you out of the game,
Mm-hmm.
because then you can't make money outside of your time. So the way I think about that is, and this is why I think it's important, the difference between diversification at like in your 20s versus your 60s is, um, I still have human capital, right?
Mm-hmm.
So I'm in my 20s, I can still work to make money. And I already had I had the ability to play poker. I was learning business. So I knew
Mm-hmm.
I could make money, had money coming in already. So I said, okay, I'm going to place this bet. And then, more money I have coming in, I'll reevaluate, but I have all this money sitting around making just about nothing. So essentially, I think people don't value their human capital at all. So I will, let's say I had no money ever coming in, I couldn't make that same bet. Maybe I would have had to keep more money for living expenses or to make my next business bet, right? So, so I think about it in terms of that. And then, what was the second part of your question?
Basically, like, how do you, like, when you look at other types of bets, and you think about going in concentrated, how do you think about, just, I guess, bankroll management and risk management?
Yeah.
Or do you only take a concentrated bet when you feel like the odds are like, call it 95% in your favor? Yeah, because I do agree with you. Like, a couple of things you said. Number one, it's always easier to make big bets when you have like non-market related income. That's why when people ask me like, Chris, should I day trade for a living? I say, hell no, because if you are trying to live off of your profits,
Yeah.
it's lumpy. You could have a year where you make a life-changing amount of money. You could also go through a couple of years where it's dry or you lose money, right? So I totally agree with that. And then the other thing I like to say is like, don't do anything that's going to permanently take you out of the game.
100%.
So we see a lot of people on crypto just go YOLO on some shit coin. It implodes and they're starting from zero again.
Yeah.
But I think there is like a sweet spot
Yep.
where you can make a big ass concentrated bet that like there's a fine line between doing that and it being the right move and being a smart play versus just reckless and gambling. Like, how do you see the difference between those two?
Yeah, I've seen a lot of people. You see a lot during the upticks of markets. Is a lot of people will only make bets where they think they can make a lot, but they don't consider the fact that a lot of the bets they enter, they could go negative 100%.
Yeah, and
so I always want a margin of safety. I don't want to make a bet where, even with Apple, like even the Apple bet for me wasn't. I knew I had human capital coming in, and so it didn't matter as much because I could fund the next bet with my incoming capital. I didn't think the 500K could just go to zero. Like their bets, they didn't have debt at the time, or they had little to no debt, and they had a bunch of cash. So I was like, this is like, I thought people were mispricing it. When I think about a bet, I mean, you know about the real estate bet that I made.
Yep.
That was, again, people would look at that as insane. Where I bought 300 properties in like 15 to 18 months. In an area where I thought they were underpricing it, and I bet all my available chips and more. Like I basically bought way more than my
you
available
levered
chips.
up. Do you want to talk about how you did that? Like what the process was? I guess like taking loans, or like how did you think about bankroll management with the real estate play?
Well, this is funny. Like I actually didn't put up much of my own capital because my Apple bet had grown so big. I really didn't need it. It turns out I could take a line from that. And
so you borrowed against the Apple stock?
I borrowed against the Apple stock. And a lot of people, and this might be interesting for people, is that a lot of people said, oh, you should free up some Apple to make this bet. But again, it's like, I always look at the math. It's like, well, what does the math say? Well, if you sell, like I'm so much profit on that, I'm going to pay a lot of taxes. So immediately you go negative 20%. on that money. And they don't factor in the other side of it where if you're paying a loan, you can write it off. And so you've got a difference of like, 20 to 30% right there that you're giving up. Where I think, and again, people are so opposed to loss instead of like looking at the gain. There's like to get a 30% return is difficult for people, but they don't make a couple plays like that. So instead of like, it would have been easier to sell and just take the cash and buy things. But the math doesn't make any sense. So used a line instead, paid interest on the line and bought most of the stuff that way. And then I took a couple like friends, family type stuff. And yeah, I just bought, basically saw an opportunity, just put a team together to email, call, mail, everything, wholesalers, you name it.
So you basically you borrowed against your big concentrated bet to make another really big concentrated bet.
Yeah.
And this is where I think people get themselves into trouble with real estate typically is through leverage, right? There's a ton of get rich quick gurus all over TikTok and shit that are like, go get a mortgage, go buy a bunch of properties, Airbnb them out, and we're seeing as prices come down and rates go up, a lot of people that were over leveraged get caught and then boom, they're bankrupt overnight, right?
Yeah.
So how did you think about the risk on this? And you can add as much color to the play as you want, tell people as much or as little about the play, because I know it's a very special thing that you did, that you made the right big bet at the right time in the right area.
Yeah.
And maybe just talk about how you found that kind of deal and like what that meant to you. And
yeah. Yeah, I'm trying to think about what I should say on it.
Yeah.
It's basically I'll leave it at I looked at an area where most people weren't paying attention to. The prices were at a point, it reminded me of like Apple in the sense that I'm like, I don't understand why people are valuing it like this. Didn't make any sense. And keep in mind, the time is important because this is I saw the bet in late 2020. And so COVID was happening rampant and it was like, okay, well, and I was just sitting around like most people just thinking, and okay, what is going to happen with this? Like work from home is going to become more popular, already was at the time.
Mm-hmm.
People are going to want to move to places that are more in nature. People are going to want to move to, if they can work from home, states that are more desirable, areas that are more desirable. People are going to want to move to places with no income tax. So basically I found like a bullseye of a bullseye for those things. And I didn't understand why, like I thought it was already currently undervalued. Mm-hmm. So not only did it have I think it's currently mispriced, it's like if you look at it like you would a stock, you're like, they're about to get a lot of business and I don't think people understand it yet.
Yeah.
And so basically it was one of those things. It's like, am I missing something or is everyone else? And again, it just came down to the math is like, I ran numbers 7 different ways. It's like, okay, if, I did a radius around different areas and I was like, this is the cheapest area you could go to. I did a desirability on these areas. I was like, if you're looking for this is, I think, the best area. And like, I ran all sorts of math and I'm like, I am perplexed at why the prices are where they are. And so long story short, I didn't initially intend to buy as much as I bought. I didn't know it was going to be able to buy that many. Because there wasn't some person who owned, X amount of properties. So I was individually buying all these, almost all of them off market.
And they were mostly just lots, right? Like predefined pieces of land that you could build on, right?
Yep. Yeah. So,
and the thesis was what? Like eventually people are going to move into this area and drive these values through the roof?
Yeah, but it was more specifically, there was only a certain number of them. Mm-hmm. And then I started looking up what were the current and past builds. So the amount of builds that were happening. And so I could pick a time frame in which there would be no more land. And so it was just a math play of like, here's what they're valued at. What I think the range is going to be when there's very few of them. Like
Yeah.
this is what it's worth when there's tons of it.
Yeah.
Or not a ton of it, but there's enough of it. And so again, it was just a math play of I think the current price is wrong. I think the future price is really going to be wrong.
Yeah.
The good news is, the good and bad news, when I started buying, it went up very quickly. The bad news is my acquisition costs got a lot higher because I thought it was going to take, I remember telling people initially, I was like, I think in 5 years, this is going to be worth at least this. And it happened in like 5 months. And so,
meaning like your projected profit or your values you thought you were going to hit in 5 years, you achieved that in 5 months? Like the market went up that quick?
Yeah. It's just like everybody started seeing it. And luckily I had already acquired a lot.
Yeah.
I think, but it was just, I don't know how many I had acquired at that point. I mean, maybe I got the first 125 to 150 and I end up buying 300 total. But it was just, and then towards the end, again, it's just a math thing, is what do I think it's worth? And then what can I get it for?
Yeah.
And because you want to have a margin of safety. And this is why when I see people who say, don't take on debt, and you look at why they said it, they bought too close. And so they lost money or they went bankrupt.
Mm-hmm.
It's like, but if you give yourself a margin of safety, you don't go buy something without, 40, 50, whatever percent you want. What is your desired margin of safety? Because then, like you're talking about the asymmetric bets, it's like my downside is protected, but I can also 5 to 10 excess.
Yeah.
And that's what you want. You just want to make a handful of those big bets and you'll win.
Do you mind sharing, I guess, like when you ran the math, what kind of IRR you were looking for or what you thought the upside was to the potential downside?
So the only ones I calculated real specific return, and the reason, like some of them, it was just the numbers were so big it didn't matter. It was just too obvious where I'm like, I don't even need to run math on these. The only ones I really ran more detailed math on, once I got past the like running calculations of like area values and that kind of stuff, is I bought a lot of stuff in areas with no utilities. And that became interesting in terms of like let me run a bunch of percentage situations, scenarios where, let's say it doesn't go up. Let's say it goes never moves up. A lot of those plays were still profitable. You can still make, 15% a year, 20% a year. And so the math on those is interesting because in those situations, your competition is eliminated because you don't have builder competitors anymore. Builders want things they can build on like today. And so a lot of times I was going at stuff that, let's say it was going to be 3 years out on a build, but all of a sudden, if 100% of your competition is on these lots, now all of a sudden you have 10% of your competition on lots. And so those prices dropped significantly. So the current fair market value of those lots is X, but because of the amount of builds happening, it's like, okay, if they get utilities there in 3 years, this one that's worth, 20 might be worth 100. Or if it takes 5 years. So in those, I specifically wanted to know, like, what is my return? Like, because I want to make sure I'm actually getting as good a return as I think on these.
Yeah, because if you're holding for multiple years out,
got hold costs.
Got the hold costs.
Don't have cash flow.
Right. Yeah, because you're tying up, right? So there's opportunity costs. Then it's like, what is my expected IRR over time? Yep. I was just thinking about real estate, at least property, and kind of the way that you've been doing it is kind of like crypto in a way. Like, hear me out. I know this sounds crazy, but crypto, at least with Bitcoin and several cryptocurrencies, it's a finite amount, meaning like the tokenomics are set. There cannot be inflation above a certain percentage, right? Yep. Real estate is pretty much the same way. Unless you're in Dubai and they're using boats to make more islands, you can't really make more land, right?
Yep.
The only question, so it's a finite asset. The only question though is the demand side. Yep. Right? Because you can go out in the middle of the desert out in Nevada or something and buy hundreds or thousands of acres
for nothing.
for $100 or whatever. Yeah. Right? But who knows what the demand is actually going to be.
Yep.
So it's kind of like, it's good to play in a space where there's limited or finite amount of a asset,
Yeah.
but the demand side is really the most key point, because
Yep.
I can go out and say, oh yeah, there's a some shitcoin ABC crypto that only has 10 coins. Guys, it's finite. But yeah, what's the demand for it? All right. And that's ultimately what drives price. And that's when I see people in the crypto space get excited about tokens just because they're finite or they have a falling supply. It's like, yeah, but that inherently doesn't mean price is going to go up. The demand side has to be there. Yeah. And so I think what was interesting about the play you made was like, you looked at criteria, like where are people going to want to go? You know, how is the world changing and where are demographics going to push people?
Yep.
And let me just go and try to get all of that asset, as much of a percentage as I can, and basically kind of corner the market, I guess, is what you did, right?
Yeah. And we talked about kind of like the information asymmetry too, is like, and once you, like, it got to a point where I had more data than anyone. Like I had more data than the MLS because I was doing so many off-market transactions. There wasn't even close to as many on-market transactions. And so a lot of times I had more data on the buy and the sell side that, you know, because I got contacted by people who were looking to buy certain things and I knew the prices they would pay if they couldn't find that kind of thing on the market. So you get to a point, that's the benefit of these concentrated bets, is like you have so much more information. It gives you even more of an edge on your own bet. I know if I can go up or down on my offers based on like what's the true market, because if you go into a realtor, they don't know. They don't have enough data.
Yeah.
They're just looking at MLS comps. And so unless they have, you know, when you're buying and selling that many properties in a tiny time period, your data is going to be so significant to everybody else. So that gives you an even greater margin of safety, is like, okay, I know I need to lower my bet to here, or I can raise my bet to knock out any competition, where they won't have that data. So they have to just gamble with what the comps say.
Gotcha. Man, that's so interesting. So, okay. So you've sold a bunch of them off to recoup capital?
Yeah, I sold about 100 of them.
Okay. And you're still holding a couple hundred?
Yeah, I'm going to hold for long term.
Okay. So how are you thinking about that piece, right? Because right now, interest rates went through the moon. The real estate market is basically locked, right?
Yep.
Anybody that has a 2 or 3% mortgage doesn't want to sell.
Yeah.
Anybody that wants to buy, A, has a hard time qualifying, and B, has a hard time justifying the prices and the payments at the rates. So yeah, how are you thinking about this other holding piece?
Yeah, I mean, it's I think about the long term differently. Like, I don't care so much about what happens in the 1 to 2 year time frames. I mean, if the market goes down, goes up some, the fluctuations, because like you said, now real estate right now is like, I don't foresee anything positive happening for the next year or so.
Yeah.
Maybe 2 years or so, maybe longer. It's because like you said, I mean, people that have, unless they have to move for a job or something like that, if you own a home, you're probably not selling because your rate is locked in low. The rates are so high right now, it's obviously bringing home prices down, at least in many areas, which if home prices coming down, a lot of times if builders got in at a certain price, their margins are shrinking, which gives them ability to buy or build less. So obviously land prices either stagnate or suffer because of that. So if anything, all it does to me is say, oh, okay, well, if I projected it to be, you know, potentially this price in 7 years, maybe it'll take 8 or 9 or whatever. But because of the prices I bought it, it's irrelevant to me. Like if it takes 5 years to get to a certain price or 10, because I bought at such a low value. I mean, like some of the stuff I bought at like the current value of the properties, like in what I bought in the past is like 10%.
Wow.
Of
so it's up at 10x basically, or
no. Some of them. Okay. Some of the properties, but like when I started buying, I was buying with such a margin of safety that and the prices were so much lower because they 3x'd like as soon as I like got in the game, like, you know, 5 months in or whatever. And so my cost basis is so low that it doesn't matter. It's like, it's not like I am at like 100%, like I have 100% of the value of my money in. And so if it goes in, I'm in trouble.
Yeah.
It's more just when do I make a big cash out?
Gotcha. It's kind of like akin it to the Apple stock bet. It's like you got in, let's say Apple doubled the year or two after you bought it, and then you're seeing the thesis play out. Maybe Apple had a bad quarter, prices are down a little bit. That doesn't mean the thesis fell apart. It's just like, well, I might need to hold a little bit longer, but the CAGR, the compound annual growth rate, is still probably stupid. So you're not going to get hurt. You're not going to lose your capital. Right. And the thesis is just playing out, right? I guess a lot of people get shaken out of trades or bets that they make because of emotions, right? That's one thing that I've done wrong in a lot of big bets I've made, is overmanage them or think that more activity and more doing more is going to get me more. But sometimes just sitting on your hands and letting the damn thesis play out is the most profitable thing you can do.
Yeah. It's I think that's where poker helped a lot, is that you lose hundreds of times an hour. And so you get used to losing on hands you should have won, like, things happen, but you understand the short-term variance is just all part of a bigger plan. Like a poker graph looks like this, so it goes like this, but if you know what you're doing, like long-term, it goes like that, where it's when people look at the graphs in a very small sample size, they look like this. So it seems insane. But if you just hold it over the long term, there's so many times, quarters or years or whatever, where people are like, oh my God, sell Apple. That's happened so many times in the last 12 years. And, a bad quarter or horrible news, or like, China's going to happen. Like anything could happen to it.
There's always a story.
Always something.
Yeah.
But again, because I'm just focused on the long term, do I still believe, based on the data I have, that this is a good long-term bet? And as long as the fundamentals of the bet don't change, my decision doesn't change. It's when I have new data that would tell me this is no longer a bet. For example, like you said, if someone went and created another giant patch of land somewhere right next to it that was better, cheaper, all of a sudden I'd be like, my data has now changed. I need to reevaluate this bet.
Yeah.
And so I think that's where a lot of people get into trouble, is they look at the emotions, they get caught up in the emotions. Oh my God, the market's going down. The news is saying it could crash totally. I need to sell everything. So what would happen in my situation if I did that is, not only would I sell, pay a bunch of taxes, I'd flood the market, so I'd drive the prices down even more. And then I would need to figure out, where do I allocate this capital now that I've given my government partner a big chunk of money? Like, so it doesn't, like, the math doesn't make any sense. Like, if people just sit back from the emotion and say like, all right, what's the math really look like in this? Okay, I wanted, if it might crash, let's run the math on that. What does it mean to me? What if it doesn't? What are the percentages? You can look at it, but I don't even get caught up in a lot of that. Like, once I run the math, I know what I want to do for the decision. Unless I have new data, or I have a new goal, like let's say I need tons of cash for a different project I want to do, that may change my decision. But the bet itself, I don't let the emotions of the market change me. Don't get me wrong, I'd love to see it just going up all the time, like everyone else. But I don't let it affect me that it could be a rough market for a couple of years, but it doesn't change my bet. It's the same. I love the farm analogy. I don't know if you know the Warren Buffett farm analogy.
No, which one?
I don't know if I'm going to get this 100% right, but he has something along the lines of, most people respond to the market like an absolute crazy person. So let's say you own a farm, and, one day your neighbor runs over and is like, hey, I'll give you $100,000 for this farm. And you say no. And the next day, he runs over and says, I'll give you 80. And the next day I'll give you 120. Like, he's just this crazy farmer. It's your farm is probably worth the same. You just have a crazy neighbor. So long term, little variables, interest rates will affect it. But try to think about these things as like a crazy neighbor who's just trying to buy your farm. But long term, if you think you have a good farm, you keep the farm.
Yeah.
And I think the analogy is way, like, the
no, that
way
makes
better,
sense. I mean, price action just reflects like the action of all the traders and investors, right? That doesn't actually mean that something is priced correctly.
Right.
And so, yeah, I think what you're saying is like if the thesis is intact and you like either the company is profitable or the reasons for the bet are in play,
Yeah.
don't capitulate out. Don't panic sell just because something bad happened. That's happened to Bitcoin, several times over the last decades. There have been obituaries written where Bitcoin has died like something like 500 times now. If I let that scare me out, I'd have left a lot of money on the table, right? Same thing for stocks, real estate, any kind of concentrated bet you can make always has opportunities to get scared out. And like, there's also opportunities to get enticed into a low EV play or a low probability play.
Right.
Do you have any ways that you try to filter out bad opportunities?
Yeah, I mean, as risky as my bets seem to a lot of people, I try not to actually make super high variance plays. And so I look at these bets as like they don't seem very high variance to me.
Mm-hmm.
So for me personally, I don't love, huge swings financially for myself. In terms of, so I wouldn't go, bet 100% of my money on something that may or may not work out, even if it has super high EV. Because of the fact that I think people need to calculate like what is the life you want to live. So for example, I see a lot of people making bets that their life is negatively affected if they lose, where I never want to make a bet where I'm not living the life I want if I lose. So with either of those bets, like my lifestyle remains 100% the same. If Apple didn't go well, if that bet didn't go well, any bet that I have, if it didn't go well, my life is 100% the same. It's unaffected. I see other people making bets with money that negatively changes their life, takes them out of the game, like you talked about. And so I avoid those. I only look for things like, do I enjoy it? Like I enjoyed making those bets. Like that was fun for me. I liked researching it. I liked making the bet. I liked analyzing the whole play and then executing the strategy. Like that was a lot of fun. So for me, I want to enjoy it. I don't want to just research stuff that I don't have any interest in. And then I want to make bets where I think the math almost tells you what to do. Like the math is so easy. And this is what I think a lot of people that get into common opportunities, they try to make the same exact bets as everyone else. The market has lowered the returns down to what the market can get. Like if everyone isn't in a certain bet, there's no more edge. Or if you look at the type of bet I made, the edge was huge because no one's in it. So I look for bets like that where no one's really paying attention to it.
Yeah.
Or everyone is just, I believe, has mispriced it. So the combination, I want to enjoy it. Have people mispriced it? Is there a margin of safety? Does the math pay me as well as I want to make?
I love it. I feel like we approach that pretty similarly. Like I'm always asking Travis and Nikki, like, what is going to be huge that nobody is paying attention to yet?
Yeah.
Right. There's always something coming. And I think that's like one of the most exciting things about being an investor or trader or entrepreneur is like just thinking about trends and thinking about how the world is going to change and how you can be there before everybody else. That's what I love about it, man.
Yeah.
But I guess another concentrated bet you're making is the book you've been working on for a long time. Yeah.
The longest book ever. Yeah.
What is there anything you want to say about the book or what's going to be in it? I know you're still working on it, but what are people going to get out of it?
The goal is to make it where it's almost a simplified way to grow wealth. And that sounds like, I think when you put the math behind things, it's simplified. So it's almost like it's not my opinion. I tried to make a book that was, let's look at the math on a lot of these basic decisions and show you why the majority of people are making the incorrect ones based on emotion. And if they looked at the math behind these decisions, people would realize what's viewed as a risky route in life and in investments and careers is actually a significantly safer route once the correct sample size and time frame are applied. And so it talks about a lot of the things I've learned from poker, from business, from investing, and I try to simplify it down to like, why is there not more of an algorithm for wealth? Hedge funds and traders have a lot of algorithms. It's like the average person who wants to make a lot of money, there's no blueprint to like life with a lot of these decisions. And it's like if people can learn to make decisions with some very basic logic, uh, wealth is just a byproduct. Like it's not some complex thing. And I think people try and overcomplicate that it has to be hard and you have to work really hard for 30 years and do these things. And it's just not the case. And more importantly, it's not the case that you have to take risk on. Most of my bets, they have a huge margin of safety. There is little to no risk. And I think, and the ones I make, I assume most people won't want to make the same kind of bets, but I try to write a book that it teaches them how they can apply the things they want to do, but some of these same principles to achieve the kind of money they want to make.
I love it, man. I'm looking forward to it. I want to be first in line, and we'll get a bunch of books and send them to a lot of our listeners and viewers, man. So,
thanks, man.
Dude, thanks for coming in. I'm looking forward to doing another interview when the book comes out.
Yeah.
I've got a ton of follow-up questions. I know we're like over on time, but man, this is so valuable. Thanks for sharing everything.
Yeah, man. Thanks for having me.
Yeah, brother. We'll see you next time.
Definitely.